we're going to be in maybe a depression, but at least a deep recession. It's not going to take that long. I'm saying in the next year, this 5.2 is going to drop off. That's disinflationary, deflationary, weakening for the economy.
In today's video, Harry Dent, author of 0 Hour, talks about what's up with bonds, the next moves of the Fed, the raging inflation and the coming recession. Dent has been predicting a great reset of the biggest financial asset bubble in history. The market historian predicted a painful crash in stocks and an economic depression, and discusses the next moves before the big crash. He believes that the top is in and the Fed is tightening aggressively. Could the markets make a new high?
Does anyone call you Harry Bearish, or there's a nickname in there?
Some people started calling me a perma bear. Look, I've been forecasting since the early 80s, and I've been the most bullish guy. People used to call me the crazy bullish.
Right.
I was the guy that said this boom's going to last way longer, go way high. I had a Dow 10,000 by 2000.
I remember
back in the 80s. People thought I was crazy, and I still underport. It was 12,500 by 2000.
Yeah.
So it even went higher than I thought when people said, "Well, Harry, we know that's not possible." Back then, everybody thought America was done. I'm like, hey, long term, we are peaking out and aging like most developed countries, but we got the biggest damn baby boom. That's the secret.
Okay.
2007 was when the baby boomers in the highest and final numbers would reach their peak spending. And that spending comes as they're raising their kids and getting them through high school, college, or graduate school, however long the kids can trick their parents into paying for them. Right. I went all the way to graduate school, so I got the best deal in my family. But so that was back for the baby boomers, age 46 was that peak of spending, and the peak of the baby boom birth curve, before it dropped off, was 1961. So that was just 1961 plus 46. I was predicting all the way back in the early 80s, talking to small business people back then at Tech and YPO. I said, this is going to be the greatest boom in history because this generation is so large. And even though the U.S. is an aging nation and all that sort of stuff, and Asia's rising, we got one of the best baby booms in the world, and we're going to have a hell of a boom. And we did. Now, what happened, though, and what has been very hard to read since, we did have that downturn right when my indicator said 2008 was the worst downturn we had seen since the early 80s. At the bottom of the whole last generation cycle, the Bob Hope generation was bottoming in 80 to 82, and that was the worst unemployment, 10, 11% back then, as bad as we've seen since. So now the question is, okay, the baby boomers have peaked. Right now, where we're at on this cycle, Jason, we're at the bottom of the baby bust down cycle in 2022-23. That was my forecast way back too. So what's happened different this time, and never even close before, not even in the Great Depression, when 2008-9 hit harder than anybody expected, they just started printing money. And they thought, okay, they started with $1 trillion. And I would have even done that if I was the government back then. $1 trillion, they thought, okay, the economy's in a funk, $1 trillion in a, $16 trillion economy, whatever it was back then, that'll get things back going, and boom. Well, it didn't, and they just had to keep printing money.
Okay.
Why? Because the fundamental demographics said, no, we're in a long-term downturn. And this is history. Every 40 years, every generation, real quick, 30 to 42, long-term downturn after the great roaring 20s peak, 68 to 82 after the Bob Hope generation boom, 40s, 50s, 60s. And now after 83 to 2007 baby boomers, the demographics are weak right into 2022, 23. And it's next year that we should actually naturally turn up with the millennial generation, which will not be as long a boom as strong, but we should have good fundamentals again. But we've been having all this stimulus, Jason, and why it's taken them so much. Nobody thought it would take 14 years of stimulus and we'd only be tightening for the first time last year after all of this. It's because the demographics really were adverse and slowed the economy.
I remember you saying back then in 2004 that you were expecting deflation. And I know you've been a fan of the Elliott wave theory, and we had Bob Proctor on the show and his associate talking about Elliott wave before as well. Are you still in that camp, or has that changed at all? And you reminded me of it because of this 5.2 trillion injected into the economy and the 3.6 trillion
that
back
5.2 trillion had two purposes: to get the economy out of a funk and to prevent deflation.
Sure.
If you look at history, the worst times are not times of rising inflation. Those are bad.
Yep.
The worst times are deflationary periods like the 1930s. And many periods before that, the 1870s and 80s were deflationary. The 1830s and early 40s were deflationary. Those are not periods that they call recessions, Jason. Those are called depressions. Why? Because financial asset bubbles that blow up more than anything else, way more than the economy does with stimulus, those financial assets go down and wealth just disappears. And that makes the spending, particularly of the top 20%, who actually control 50% of the spending in the economy, that makes their spending go down, and that's what hurts the economy.
Okay, so is the future still, according to Harry Dent, deflationary? Or
it is when it hits, and to do this, the economy has to slow, and which means this 5.2 trillion has to wear off. We're not slowing because this 5.2 trillion is still working its way in the economy, but it's not going to take that long. I'm saying in the next year, this 5.2 is going to drop off. That's disinflationary, deflationary, weakening for the economy. And on top of that, which is something new that they just did in the last year, like you said, they started in March of last year, this taking rates from 0 to 5.25 and probably at least to 5.5 before they're over just ahead. That rate hike is going to slow capital investments in home buying and all this sort of stuff. It's not doing it yet because people are already rolling. It has a lag too. What I'm saying here, we will not know where we're at until about a year from now. So anybody judging today, just saying, well, they raised interest rates this much and it's not slowing things that much, has no idea what
Harry, look, we know part of it because it started over a year ago. So we don't know all of it yet, but we do know because it's iterative. They have a meeting every month and they've raised it, 11 times?
You're not listening to me.
Yeah.
Okay. I'm sorry. Okay. You're not listening to me.
Yeah, go ahead.
We don't have one thing going on here. Okay. Yeah. We got this giant 5.2 trillion. Now we got this tightening. Okay, these things are on different clocks, happening at different times,
right?
And they all have lags. You have to think in lags to make any sense of it.
Yes, I know.
That's what I'm trying to do.
I agree.
Add a 1 to 1.5 year lag to this 5.2. You understand why the tightening isn't having much of an effect yet? I'm saying, and I'll stake my career on this, the next year we'll see more weakening than people are expecting because of these lags, both lags.
Okay.
The 5.2 trillion stimulus will wear off, as any stimulus does, because it's temporary and not real. Okay.
And they've been mopping it up.
Long term, like a generation's been more. And this tightening will keep digging in and hitting harder over the next year. So we won't know where we're at until the summer or fall of 2024. And I'm saying we're going to be in maybe a depression, but at least a deep recession.